Hello, my dear investors. If you are planning to make an SWP, that is systematic withdrawal plan, then you must know what is the taxation in SWP. So today we will discuss about the taxation in Indian regime about the SWP plan of mutual funds. In simple words, we can say SWP is not taxed as income. Every withdrawal is treated as a redemption of mutual fund units, and only the capital gain portion is taxable. The applicable tax depends on the holding period of the units redeemed. Now, let us clarify the issue. First, take the example of equity mutual fund. Now, in case of equity mutual fund, if units are redeemed within 12 months of purchase, then the gain is called short-term capital gain. And in such a situation, applicable tax rate is 20% plus applicable surcharge and cess. On the other hand, if units are redeemed after 12 months, then the gain is called long-term capital gain and tax rate is applied on 12.5% on the gains if such gain exceeds rupees 1.25 lakhs in a financial year. Do you think it is a bit complex? So let us understand with the help of an example. Suppose you invested rupees 20 lakhs in an equity oriented mutual funds. Now, after 18 months, you start an SWP of rupees 25,000 per month. Now, let us understand what is the phenomenon. Now, each monthly withdrawal consists of two parts. The first part is return on your invested capital, which is not taxable, and the second part is capital gain, which is taxable. Only the capital gain portion is taxed. Since the investment has already completed more than 12 months, so the gain on those redeemed units will generally qualify as long-term capital gain. And on such long-term capital gain, you will get a flat deduction of rupees 1.25 lakhs in a financial year. And what remains after such deduction will be taxed at 12.5%. Now, let us discuss on debt mutual fund. For debt-oriented mutual funds purchased on or after 1st April 2023, capital gains are generally taxed at your applicable income tax slab, irrespective of the holding period. The earlier long-term indexation benefit is no longer available for these investments. Now, we will discuss few important rules. The first rule is FIFO. Mutual fund units are redeemed on first in, first out basis. That means the earliest purchased units are redeemed first. Their holding period determines whether the gain is short term or long term. Now, before you start an SWP, let us discuss few important planning tips. Number one, for retirees, it is often beneficial to invest the lump sum first and wait for at least 12 months before starting an SWP from an equity fund. Whether it is practicable or not, you have to decide for your case. This can help ensure withdrawals are taxed under the more favorable long-term capital gain rules rather than short-term. In nutshell, we can say SWP is not taxed as income. Every withdrawal is treated as redemption of mutual fund units, and only on the capital gain portion is taxable. The applicable tax rate depends on the holding period of the units redeemed. I hope you have found some valuable information from this video. Thanks for watching the video. Please like, share and subscribe our YouTube channel. Thanks again.